Hey guys, welcome back to the channel. To all you new people out there, welcome. I really appreciate you. For the ones that have been watching my channel for a while, you'll notice probably the last few videos that have had a lot of flickering in the video, and I just want to apologize for that. If you endured and watched my videos anyway with that flickering going on, I just want to say thank you very much. Hopefully I have it figured out. I'm using my iPhone to record, and it's through an app and through a USB connection through the PC. So I found out that sometimes the USB connection will cause some electrical interference, and that might have been the cause of the flickering. So I'm hoping that this video I have solved it, and we'll just see. So if you're new here to the channel, please give me a like and subscribe. I go over and review a lot of ETFs, a lot of things that I'm researching. I go over dividend income of my own. I follow a paper portfolio that I track a covered call strategy on. And if that, I'm going to retire in 10 years on $250,000. That's the point of that paper portfolio. And I want to prove the naysayers wrong that you can't retire on a smaller, I'm not calling $250,000 small, but on a regular scale, most people will say, you need $1 million to retire. We're trying to nip that in the butt and make it happen. So give me a like, share, subscribe, comment down below, and let me know you're new and how you got here and all that good stuff. I'd love to have some conversations with you, and let's get going. So today what we're talking about is, I know I always talk about dividend ETFs, and that's important, but I think also having some exposure to the total market is also important. Okay, it's something that I haven't done yet, and it's something I'm looking to do. And the ETF I'm talking about today exposes you to the total market, and we'll take a look here and we'll go over it. It is a very cheap on the expense ratio. It's very affordable for the share price, and it has some great dividend growth over the past 10 years and good returns. I mean, it's a market ETF, total market ETF. So we'll take a look at it. I haven't seen anybody talk about it yet, so let's go over the index. So the index we're talking about today is the S&P Composite 1500. Now we'll just go over briefly over this stuff. It combines three leading indices: the S&P 500, the S&P Mid Cap 400, and the S&P Small Cap 600. So it covers about 90% of the US market cap. And let's see if we can find out how it figures it out. So here we go. Eligibility market cap. So for the S&P 500, it looks for at least a market cap of 8.2 billion or greater. For the mid cap, they go for 2.4 billion to 8.2 billion, and for the small cap, they go 600 million to 2.4 billion. Now, financial viability. So to be included in this index, companies must have positive as reported earnings over the most recent quarter, as well as over the most recent 4 quarters summed together. Adequate liquidity and reasonable price. Using composite pricing and volume, the ratio of annual dollar value traded to float adjusted market cap should be at least 1. And the stock should trade at a minimum of 250,000 shares in each of the 6 months leading up to the valuation date. Sector balance is measured by a comparison of each GICS sector's weight in an index with its weight in the S&P Total Market Index. So all eligible U.S. common equities listed on eligible U.S. exchanges can be included. REITs are also eligible for inclusion. Closed-end funds, ETFs, ADRs, ADS, and certain other types of securities are ineligible for inclusion. So let's take a look and see. The ticker I'm talking about is SPTM, and it's the Spider Portfolio S&P 500 1500 Composite Stock Market ETF. Trades as of today's recording, it's trading for $36.67 a share. It is passively managed, has 98% in North America, 2% in Europe, and a little bit everywhere else. Top 10 components is about 25% of the fund, and those top 10 components are going to be very recognizable names. 5.5% in Microsoft, almost 5.5% in Apple, 4% in Amazon, 2% in Facebook, combined almost 3% in Google, 1.3 in J&J, 1.2 in Berkshire, a little over 1 in Visa, and 1% in Procter & Gamble. And the other 75% is in the other 1,392 stocks that the ETF holds. I'm sorry, did I say that wrong? I think I did. 1,482 other stocks that the ETF holds, because it has a total of 1,492 holdings. So we'll see you have almost 83% in large cap, 10% in mid cap, almost 5% in small cap, 2% in micro cap. Sector exposure, you're looking at 26.5 in tech, 14.25 in healthcare, 11 in consumer discretionary, 10.5 in financials, 10 in communications, 8.5 in industrials, 6.6 in consumer staples, 3.2 in real estate, 3% in utilities, 2.75 in energy, and almost 2.75 in materials. Morningstar has this categorized as a large cap blend. So let's take a look. Key stats. I can't say statistics. So I'm going to just say key stats. And we'll look at, you notice that I've looked at turnover before. Annual turnover ratio of 4%, which is very good. What does that mean? Is that this ETF will avoid most capital gain distributions at the end of the year, because they're not replacing or trading stocks very often. So if an ETF, if you're holding it in a taxable account, and an ETF with a high turnover ratio is you're holding it in a taxable account with a high turnover ratio, you will get hit with a higher capital gain distribution instead of, say, qualified dividends. So depends on your income level, tax status, all that good stuff, but generally a low turnover ratio is favorable for a taxable account. So we'll take a look at the dividends here. Like I said, the expense ratio 0.03%. That's cheap. It has go to the dividends, it has a yield of 2%, so it's kind of like the market, like the S&P 500. It says a 5-year growth rate of 5% and dividend growth of 4 years. Let's take a look at the dividend growth here. Look at that 1-year growth rate of 16, 3-year growth rate of 8, 5-year growth rate of 5, and 10% is a very respectable 11.5% over 10 years. And you'll see that's because of that little dip we had from 2013 to 2014. Now they did split the shares in 2017, and what that does is it actually keeps the share price low. It's not detrimental to an ETF, but it keeps the share price low, and it encourages people with smaller sums of money to buy, really, because if they didn't split, you could run this price up. That's how VOO, for instance, is, you know, in the 200s a share and things of that nature. If they split it, they could bring that cost down, barrier, you know, that cost of entry down. So that's why you see this is trading at about $36 a share. So we'll take a look finally at the 10-year performance. If you were to put in $10,000 in this fund 10 years ago, roughly, we'll just say from January 1st, 2010 to today, what would it have done? So we'll chart that. Let's take a look. Bring this over here. Whoops. And so if you put in $10,000 into SPTM in January of 2010, today you would have $32,123.98 for an average annual total return of 11.78%, total return of 221.13%. Now, if you didn't reinvest the dividends, your return would have been slightly lower at 11.05%, with a total return of 199.83 and a total ending investment of $29,992.29. So that's what I have for you today. SPTM, an excellent total market ETF at an affordable price and a very low expense ratio that'll give you exposure to the largest companies in America, you know, mid-cap companies, small-cap companies. It's a good overall ETF for a diversified portfolio. Let me know what you think. Leave me a comment down below, like, share, subscribe, do all that good stuff. I appreciate you guys being here, and we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.